What is going on, everybody? Steve here with IBC Global. Today, we are going to go through whole life insurance, how it works, when people love it and think it's the best place to put money, period, and then when people hate it. Have you ever heard bad things about whole life insurance? The answer is most likely yes. And I can tell you from experience, we work with individuals who put away a couple $100 per month into whole life insurance policies, all the way up to banks that make deposits of 8 figures per year into high cash value life insurance policies. And it can work beautifully or it can work not so beautiful at all, depending on how it's set up. So basically, when it comes to whole life insurance, traditionally, what most people are aware of is a life insurance policy. A price quote. For example, if I am a 40-year-old individual and I am going to purchase a $1 million whole life insurance policy, that premium, depending on the company and product, could fall around $20,000 per year. Now, when you think life insurance, if you're looking purely for life insurance and I tell you, hey, here's a life insurance policy, it's going to cost you 20 grand every single year, what are your thoughts? Well, you can easily go online, shop term insurance, and we find the same $1 million policy for $800 a year or something like that. Significantly less from a price standpoint. So where whole life insurance often gets a bad rap and is not a good area to put money from a savings component is if I'm interested in, let me rephrase, if I'm shopping for life insurance and I look at whole life insurance, I see this huge premium. I view it as expensive. It's just not for me. Cash accumulation, building cash value is not my primary objective. Maybe someone is attempting to sell you on that to say, hey, look at this cash value benefit, it's tax-free, safe, all of this good stuff. But you say, hey, I'm interested in life insurance and this is just far too expensive right now. This also generates a very high commission as the underlying premium is very high. So that is a traditional life insurance policy. I have a death benefit, I make a premium payment. As the years pass, cash value eventually accumulates. I do see it build up, but it takes a very long time to see any real value, and I've got this expensive premium ongoing. That is a traditional, old school whole life insurance policy. Then you can take a whole life insurance policy and do this, a high cash value policy. And the interesting thing is it's often the exact same product, just set up differently. So for example, a case like this would be like the bank I mentioned, or a lot of wealthy individuals do this. They view a cash value life insurance policy not as, it is life insurance, but not primarily as a life insurance need, meaning the death benefit, that is not their main concern. As far as the payment is concerned, well, you, the consumer, decides. When a bank makes a deposit, so for example, when we work with banks and they say, hey, I want to allocate this much money to a policy this year, they're saying, here's how much we want to deposit, maximize my cash value, and then what's the death benefit look like? If we work with an individual who's 30 or 40 years old, putting in, maybe it's $5,000, $10,000, maybe it's $100,000 per year, whatever they decide, what we are doing is just like we would for a bank, saying, okay, here's the payment. You're going to pay it annually for a certain number of years. Here's the cash value. Maximize that first and foremost. And then here's your death benefit. And we see this premium PUA, 10, 90%. That has to do with when you're making a payment, how low we can go with the premium. With some of the top companies is 10%. Some companies will allow you to go lower than that. So to clarify is if you said, hey, I want to pay in $10,000 per year, what that would mean is that your actual minimum commitment could be approximately $1,000 per year, or 10%, and you have the ability to add another $9,000 that all goes toward cash value. That PUA rider is a means to accelerate cash value. And this type of design, this high cash value setup, also minimizes the commission. So this is where people begin to become intrigued with these products to say, okay, I've heard of some of the benefits around whole life insurance, but then I also hear these horror stories and that it's so expensive, like why would I put money here? So to give you some of the core benefits here, when it comes to a whole life insurance policy, we have the following. On your left, we see my chart here. You can tell I'm not the best when it comes to artwork. With a whole life insurance policy, we do have a premium. That premium is level for the life of the policy. Now, this does not mean that we must make payments our whole life. That is not the case at all. We can easily have a policy where we pay into it for 2 years. Maybe it's 5 years and then nothing else thereafter. Maybe I have an intention to stop at age 65, or maybe I do want to pay into it forever. My point is, we can choose when we start a policy. We can also adjust as time passes. So we have a ton of flexibility as far as how long we pay into it, and also the dollar amount. So many people are attracted to these products really for the safety, liquidity, and tax-free benefit, which I'm going to touch on shortly. But what they're not attracted to is a bill where they have to pay the same amount of money every year, every month. They don't like it. What they do like is really that cash value component. They say, hey, can I just use a lump sum of money or just pay into it until a certain age, or start with a minimum premium and add more at discretion? And the answer is yes. We're going to look at an example of that very shortly. But as we make payments, what happens with these products, their cash value continues to increase over time. We do have a death benefit that increases over time as well. Death benefit is the actual amount of life insurance, meaning if I die, that is what is paid out 100% income tax free. If I am very wealthy and I'm above the estate tax limits, that is not estate tax exempt. I would need to set up a special type of trust in order to make sure that everything is still paid 100% tax free income and estate tax. So here's really the point of interest here, the cash value benefit. So our core benefits are as follows: safe, liquid, tax-free. Specifically in respect to the cash value piece with a life insurance policy. This is what everyone is interested in. Safe. What I mean when I say this is that your money is in no way, shape, or form invested in the stock market. If things are going very, very well in the stock market and the economy, I can expect this policy to produce somewhere in the neighborhood of a net IRR, which stands for internal rate of return, actual growth rate, between 3 to 5%. If things are going very, very poorly in the market and economy, I can expect a net internal rate of return of 3 to 5%. I'll see a guaranteed minimum interest rate, typically ranging between 2 to 4%, depending on the company, product, when the product was purchased. If you'd like more information on that, let us know. We can provide some. We've got other video content as well. But safety, no risk at all. Money just continues to go nowhere but up as the years pass. Liquid, I can access my money anytime I want. So I can start a policy, hypergrow the cash value, and access it in the same year if I choose to do so. Compounding, what this means, a unique feature to the cash value in a life insurance policy is that once you make a payment, regardless if I just let that dollar sit and grow and earn, call it between 3 to 5%, or if I elect to borrow against it, if I take out a loan, which I do not have to pay back, but if I take that loan out, I continue to earn the same 3 to 5% on the money still in cash value and what I've loaned out. Another way to put it is that there's no lost opportunity cost. Think of it this way. If you have a piece of real estate that continues to appreciate over time, if you borrow against it, the fair market value continues to appreciate. So nice advantage there, and we've got more content on policy loans as well. And tax-free, this is where so many people are attracted to it. It's tax-free if it's set up right. We have these terms, no MEC, so we need to make sure we don't trigger a taxable event, and also that we don't lapse the policy. So if I grow a policy, if I pay $100,000 into it and it grows to $300,000 and I just cash it out, that would be a case of where I would have to pay income tax. To access that money tax-free, I can always take withdrawals up to what I paid in and then take loans out as well without paying them back, as loans are tax-free, as long as I don't trigger this modified endowment contract. A lot of info here. Let's look at some quick examples going back to the first option, a price quote, and then second, how to maximize a policy for high cash value. What we've got here is a 40-year-old male paying in, or I should say, initially just purchasing a $1 million life insurance policy. At age 40, it costs him approximately $20,000. A clean $1 million death benefit actually costed him $19,550. I rounded it up to 20. And this is a basic whole life insurance policy. Traditional whole life, price quoting. I've got my death benefit of just over $1 million. I pay in $20,000 per year. The first year I make that $20K payment, I have next to nothing in cash value. When it comes to the premium piece of a life insurance policy, it doesn't show up in cash value in the first year, sometimes the first and second year. As time passes, he continues to make his payment. If he dies, he has life insurance, but as I look at the cash value, what's highlighted here in yellow, year 13 is where he's paid in a total of $260,000, and he has $260,000. So often, when it comes to whole life insurance, if one is interested in the death benefit, this is just a basic whole life insurance policy, death benefit with an expensive premium. And by the way, we eventually see that cash value benefit. If someone is interested in a high cash value life insurance policy and they are shown or they are sold this is typically where buyer's remorse comes into play, where they say, wait a minute, this does not make sense because I have such a huge lost opportunity cost here with the negative cash values. But then we see the exact same product with the exact same company, same individual, paying in the same dollar amount, very similar death benefit, $1 million initially, $20,000 per year. I have annual funding because the actual premium is $2,000 in this example. That's his commitment, and he can pay up to $20,000. There's his cash value right off the bat. Still not super attractive in the first year, but much better than this guy with the same company and same product. Breaking even, year 6, when he has more cash value than what he's paid in. And then we also stop the payments altogether after 15 years, pay nothing in, not even the minimum premium, and it continues to grow. And there's his internal rate of return, the net growth rate, which, if we don't trigger a taxable event, that is tax-free as well. No risk associated with the product one bit. I remember early in my career, I was at a training event and someone had made a statement as far as 2008, everything tanked. My whole life insurance policy values just kept going up. He loved it as far as what the dividend paid and such. Here's another quick example. On the left, we have the same policy we just looked at with that $20,000 per year going in, positive year 6. So what's highlighted in yellow, that means at $20K per year. I've paid in a total of $120, and now I have that. Then, hyperfunding it. A lot of people like examples like this where they say, okay, let me get the same $300,000 in, but I don't want to have to pay until I'm 55. Let me do this. I'm going to fund up until I'm 45, 6 years in this example. I break even year 5. Death benefits very similar right off the bat. Nothing after 6 years, and cash value just keeps on going up. We minimize the death benefit here to maximize the cash value growth. We've got some content on that, but what we did was really just maximize the cash because that is what this individual was interested in. Same exact policy over here, but he decides to continue to make a $5,000 payment forever after that initial $300,000 payment is made. But my point here is we see an example of how to maximize cash value. Going back to the beginning, option 2, how do I get the high cash value option? And then I see option 1, which no one ever wants. I'll let you know, just to be transparent, no one that we work with wants this because I have this high premium, high compensation, next to nothing in cash value for the consumer, takes a long time to break even. And frankly, the cash value, that is what so many people are attracted to when it ultimately comes to these products. So I hope this helped. If you have any questions, or I hope you found it informative, if you have any questions, please feel free to reach out anytime. If you enjoyed the video, please hit the like button, subscribe for more, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.